If you have ever deposited or withdrawn cash, and I mean a NY amount of cash, this video could save you from having your bank account frozen, flagged, or investigated by the federal government. No exaggeration, no clickbait. Stick around, because most people find out about this rule the hard way. Let me tell you about Marcus. Marcus is a 28-year-old guy, hard worker, runs a small landscaping business on the side, spends 6 months saving up cash from jobs, birthday money, side hustle income, overtime pay, until he has accumulated exactly $12,000 in cash, sitting in an envelope at home. Marcus is not a criminal. Marcus does not watch crime documentaries for inspiration. Marcus just does not fully trust banks and prefers keeping cash. One Tuesday morning, Marcus decides he is ready. He walks into his bank. He slides $12,000 across the counter. He smiles at the teller. The teller smiles back, and then something happens. The teller disappears for a few minutes. Then a manager appears, then some paperwork, then some questions Marcus was not expecting. And within 24 hours, Marcus receives a letter. His account has been flagged. His transaction has been reported to the federal government. And now Marcus, who has never committed a crime in his life, is having to explain where $12,000 in cash came from. Marcus did not know about the rule. After today, you will. I am Zig. Welcome to Learn Finance with Zig, where we make money make sense. Today, we are breaking down the IRS $10,000 bank rule, what it is, how it works, what triggers it, what to never do, and how to protect yourself completely legally. Let us get into it. Alright, the rule itself, the Bank Secrecy Act of 1970. Yes, 1970. This has been around longer than most of your parents. Requires that all US financial institutions automatically report any cash transaction of $10,000 or more to the Financial Crimes Enforcement Network FinCEN, which then shares that information with the IRS. This report is called a Currency Transaction Report, or CT. And here is the important part. This is not optional. The bank does not decide whether to report it. There is no judgment call, no manager meeting, no vote. The moment a cash transaction hits $10,000, the report is filed automatically, every time, without exception. It does not matter if the money is completely clean. It does not matter if you are the most law-abiding citizen on the planet. It does not matter if you won it at bingo. Although if you won $10,000 at bingo, please tell me which bingo hall you attend. The report goes in regardless. Now here's what a CTR actually does. It does not mean you are arrested. It does not mean your money is taken. It does not mean you are guilty of anything. It simply means the government now knows about the transaction. They have a record. And if everything is legitimate, usually nothing happens. Usually. Now here is where it gets really interesting, and where most people, including people who thought they were being smart, end up in serious trouble. Structuring, also known as trying to avoid the $10,000 report by breaking your deposits into smaller amounts. Let me paint the picture. Marcus's cousin, let us call him Kevin, because of course, here's about the $10,000 rule, and Kevin thinks he is clever. So instead of depositing $12,000 at once, Kevin deposits $9,500 one day, then $2,500 the next week. Kevin thinks he outsmarted the system. Kevin did not outsmart the system. What Kevin just did is called structuring. And structuring is a federal crime, punishable by up to 5 years in prison and seizure of all the money involved. Not the $10,000, all of it. The law is called the anti-structuring law, and the IRS and FinCEN are extremely good at detecting it. Banks are trained specifically to look for patterns of deposits just below $10,000. Multiple transactions, same account, short time period. It does not matter that the money was completely legitimate. The act of deliberately breaking up deposits to avoid reporting is itself the crime. Kevin thought he was avoiding scrutiny. He actually triggered something called a Suspicious Activity Report, or SA, which is significantly worse than the regular CTR. The regular report says this happened. The Suspicious Activity Report says, we think this person is up to something. Those are very different conversations with the federal government. Do not be Kevin. Ever. Now let us talk about what actually makes a bank file a suspicious activity report, because it is not just structuring. Banks are required to file a SAR for any transaction or a series of transactions that seem suspicious, and suspicious is defined more broadly than you might think. Trigger 1. Multiple deposits, just under $10,000, $9,800 on Monday, $9,700 on Friday, $9,500 the following week. Even if each individual deposit is completely clean, the pattern itself triggers a SAR. Trigger 2. Sudden, unusual account activity. You normally deposit $500 a month. Suddenly you deposit $8,000 cash. No explanation, no context. That is unusual. That gets flagged. Trigger 3. Cash deposits, inconsistent with your stated occupation. You work a regular salaried job. You regularly deposit large amounts of cash. Your job does not typically generate large cash payments. Red flag. Trigger 4. Frequently exchanging small bills for large bills. Walking into a bank regularly with large amounts of small denomination cash and exchanging for hundreds. Classic flag. Trigger 5. Nervousness or evasiveness during transactions. This one gets people. If you seem nervous, if you give inconsistent answers, if you seem overly concerned about reporting thresholds, banks train their tellers specifically to notice these things. The teller is not just counting your money, they're observing the entire interaction. Now some of you are watching this as business owners, and you are thinking, Zig, I deal in cash regularly. My business legitimately takes in large amounts of cash. What do I do? Great question. Completely valid concern. For legitimate cash businesses, restaurants, retail stores, landscaping companies like Marcus, large cash deposits are normal and expected, and the IRS knows this. The key is documentation and consistency. If your business regularly deposits large cash amounts, keep records, invoices, receipts, transaction logs, tax returns that match your deposits. The CTR gets filed. The IRS sees it. They check it against your business records. Everything matches. End of conversation. The problem arises when the deposits do not match the records, when there is no paper trail, when the numbers do not add up. Legitimate cash businesses have nothing to fear from the $10,000 rule provided their books are clean and their records are accurate. The rule is not designed to hurt honest business owners. It is designed to catch people using cash to hide income, launder money, or evade taxes. Clean books, accurate records, no problem. Alright, protection time. Everything I am about to tell you is completely legal, completely ethical, and completely within your rights as a bank customer. Protection number 1, know the rule exists. You are already doing this by watching this video. Knowledge alone protects you from the most common mistakes. Most people run into trouble not because they are dishonest, but because they did not know. Protection number 2, never structure, ever. Even if your money is completely clean, do not break deposits into smaller amounts to avoid reporting. It is not worth it. The report itself is not dangerous if your money is legitimate. The attempt to avoid the report is what creates actual danger. Protection number 3, keep records of your cash sources. If you received a large cash gift, keep a record. Sold something privately, document it. Won money, keep the receipt. Saved over time, document the savings journey. If a CTR is ever filed and questions arise, your documentation is your defense. Clean paper trail equals clean transaction. Protection number 4, be transparent with your bank. If you know you are about to make a large cash deposit, call your bank branch first. Let them know it is coming. Explain what it is. A heads-up conversation costs you nothing and can prevent an uncomfortable situation at the counter. Protection number 5, understand your rights. A CTR being filed does not mean you are under investigation. It does not mean your account is frozen. It does not mean anything bad happens automatically. If you are ever questioned, you have the right to explain your transaction clearly, calmly, with documentation. Panic is your enemy in these situations. Knowledge and documentation are your friends. Now, while we are on the topic, I need to address something I know is in the comments right now, the $600 rule, because a lot of people confuse these two, and they are completely different things. The $600 rule relates to payment platforms, PayPal, Venmo, Cash App, Zelle for business purposes. If you receive more than $600 in payments for goods or services through these platforms in a tax year, the platform is required to send you and the IRS a 1099-K tax form. This means the IRS knows you received that money, and they expect to see it reported on your tax return. Now, splitting a dinner bill with friends on Venmo is not business income. Receiving a gift is not business income. Personal transfers between friends and family are not affected. But if you are selling products, providing services, running a side hustle, and receiving payments through these apps, that income is taxable. And now the IRS knows about it automatically. The $600 rule and the $10,000 rule are separate things. Both important, both worth knowing. One is about cash transactions at banks. One is about digital payment platforms. Know both. Report everything. Sleep well. Remember Marcus, our hardworking landscaper from the beginning of the video. Let us close that story out. Marcus got the letter. Account flagged. Transaction reported. He panicked initially, which is a completely understandable response. But here's what Marcus had that saved him completely. Records. Marcus had every invoice from every landscaping job. He had records of birthday money received. He had a note from the overtime pay on his day job. He had a simple spreadsheet tracking exactly where every dollar of that $12,000 came from. He walked into his bank. He showed his documentation. He explained calmly and clearly. Case closed. No frozen account, no federal investigation, no criminal charges, just a currency transaction report. sitting in a database somewhere that will never be looked at again because the money was completely legitimate. The rule did not hurt Marcus. The lack of knowledge about the rule almost did. That is the entire lesson in one sentence. The $10,000 rule is not designed to hurt honest people. It is designed to catch dishonest ones. If you are honest, your only job is to know it exists and keep your records clean. So there you have it, the IRS $10,000 bank rule. Everything you need to know to protect yourself completely. Cash transaction of $10,000 or more, automatically reported to the government. No exceptions. Structuring breaking deposits to avoid that report is a federal crime regardless of whether the money is clean. Do not do it, not even once. Suspicious activity, unusual patterns, inconsistent deposits, nervous behavior can trigger a separate report that is much more serious. Businesses with legitimate cash income, keep your books clean and your records accurate, and you have nothing to fear. Personal protection. Know the rule. Never structure. Document your cash sources. Be transparent with your bank and know your rights. And the $600 rule on payment platforms. Separate issue. Also important. Also worth knowing. Marcus is fine. He always was going to be fine. He just needed the knowledge first. And now you have it. If this video protected you or someone you know, smash that like button. Subscribe to Learn Finance with Zig and share this one. Seriously, share it. Because most people find out about this rule when it is already too late. Drop a comment below. Did you know about this rule before watching? I genuinely want to know how many people this video is reaching for the first time. I will see you in the next one. Stay smart, stay wealthy, and stay out of federal databases.